Hello and welcome again. Now we're on part two of our pre-class lecture for week one. In part one, we talked about what assets and liabilities were, and that's the first two components of the accounting equation. Now we are going to move on to equity and what equity is. The definition of equity is the owner's claims on assets. So with liabilities, it was creditors' claims. Equity now is owner's claims. So what that kind of tells us when we look at the accounting equation is that assets, which is everything that the company owns, can actually be claimed by either the creditors, which is a liability, meaning it needs to be repaid, or it must be claimed by the owners, which is equity. Okay. So in order to kind of understand that concept, we need to understand the business entity principle. And what the business entity principle tells us is that a business is separate from its owners. Okay, owners are the individuals. The business is a separate thing. So when we do the accounting for the business, we need to consider them separate from the owners. Okay, they're not one and the same. So what the business owns is not what the owner owns is not what the business owns. So the example of equity is Sarah's contribution of her savings. Okay, so Sarah put her savings into the business. They used to belong to her, now they belong to the business. However, she can claim those assets of the business because she was the one who put them in. Now, the specific account name that we use for when an owner contributes money to the business is common stock. Okay, so that's the term that we use. Common stock refers to owner's contribution to the company, what the owner contributes or puts in, and therefore now the owner can claim those assets. Okay? It's not a repayment like a loan is. They don't necessarily expect to be repaid, but they are getting the benefit of saying, look, I own this business. Okay? And so this portion of assets are mine. So let's take a look at how that transaction analysis worked with Soccer with Sarah. So here we go. It says, over the years, Sarah has saved up money she received as gifts for birthdays, holidays, and graduations. She now has $500 in her personal savings account. She put that money into SWS Inc. as the sole owner of the company. So what you see in our transaction analysis here, remember we have to look and categorize what happened. And we know that we got cash because she put $500 into the business. But again, we have to think about that concept of balance. Where did that cash come from? Who could claim it? And in this case, Sarah put it in to become an owner of the business. And that word owner is a hint to tell us, look, she's not expecting to be repaid back. She is expecting to have a piece of ownership. So that falls under equity. So what you see here is common stock, which again is the term we use for the contributions that an owner puts into the business in order to get their ownership. She put the $500 in to the business. Therefore, her claims on the assets of the business as an owner have increased by $500. So her ownership has increased. So again, the equation balances. We have plus 500 on the asset side, and that equals plus 500 on the other side, liabilities and equity. But again, we see that we've gotten cash, but we haven't made money. The business did not do anything. They did not provide any goods or services to earn this cash. Rather, Sarah was the one who put it in so that she could become an owner, to increase her ownership in the business. So we definitely, again, want to separate that concept of cash being equal to making money. So when we talk about owners, I want to show you some alternative terms that we use for owners. And I'm going to use these terms, and the book will use these terms interchangeably. So it's kind of important that you understand all of the words. But the main term is investor. But know that an investor is a party that puts money or other resources into a business in exchange for ownership. So other words we use are stockholder, because like I said, the term is common stock. Stock means ownership in a business. So if you're a stockholder, it means you hold ownership in the business. You'll also see the word sometimes shareholder or just simply owner. Okay, but they all mean the same thing. Investor, stockholder, shareholder, owner all means the same thing. So again, to recap now, the whole accounting equation tells us that everything a company owns, which are the assets, must either be repaid, which is a liability, and we repay them to the creditors, or it belongs to the owners, which is equity, and another word for owners is investors. Okay? So the whole purpose of our financial accounting is to provide information to the investors and creditors. Okay? They're the ones putting their money into this business. They need to know, is this a good place for me to put my money? If you're a creditor, you're going to say, am I going to get repaid? I want to make sure this business is healthy and doing the things they need to do in order for me to get repaid. If you're an investor, you're going, look, is this a good place for me to have my money? Or should I put it in a different company? Or is it better in my bank account? Whatever the issue is. Now, we refer to creditors and investors as external users. Now, this might be a little bit confusing, so especially when we talk about investors. So let me explain that really quickly. Now, creditors are considered external users because they put the money into the business, but they don't really get to say what the business does with that money. Okay, so when the bank loans money to the business doesn't go, oh, bank, can I pay my rent with this money? Oh, bank, can I pay my payroll with this money? Doesn't work that way. The bank doesn't care exactly what you do with that money. They just want to know that they're going to get paid back. Okay? So they're considered external, outside of the business. They don't get to make decisions of the business. They just loan the money. Now, investors are considered external as well. Now, this can be confusing because we're going, okay, especially on that example with soccer with Sarah. She was an owner of the business, so she was an investor because she put that $500 in. But she was also running the business. And the people that run business are what we call managers. Okay? But investors are not always managers, and managers are not always investors. Sometimes with small businesses, that is the case. But the bigger the business gets, the more separation there is. Okay, so I don't want you to always assume that owners or investors are also managers. A lot of investors just go, look, here's my money, do good things with it so that I can have more stake in the business. And we'll talk next class about how that happens. But they don't necessarily decide specifically any decisions of the business. For example, they wouldn't decide who to hire. They wouldn't decide who their customers are going to be. They wouldn't decide what products to make. Those are all the decisions of managers. Okay? So investors and creditors need different information than a manager does because they're not actually making decisions of the business. More, they want to know, is this a healthy business? If you're a creditor, you want to know, am I going to get paid back? If you're an investor, you are asking, is this a good place for my money to be? Managers, on the other hand, need much more detailed information. They're going to want to know, get detail on exactly what products they sell, need detail on exactly their customers and things like that. So they need slightly different information. Investors and creditors, more high level. Managers need more detail. Now, in this particular class, Financial Accounting, Accounting 1A, we're going to focus primarily on the financial information for investors and creditors who are external parties outside of the business. However, in managerial accounting, which is accounting 1B, we're going to do more detailed accounting, and that is going to be for managers. And again, managers are internal to the business because they're the ones who are making the business decisions. So that concludes our pre-class lecture on basic terminology. Now I want to make sure again that we recap. Let me see here. Sorry. Again, this is on basic terminology and concepts. We talked about the definition of accounting. We talked about what the accounting cycle is and what transaction analysis looks like. I gave you a couple examples of transaction analysis with part 1 and part 2 of Soccer with Sarah. But in our next class, we're going to do a lot more transaction analysis. But again, I just wanted to make sure that you had a couple examples and understood the terminology so that while we're in class, we can make the best use of our time and talk about some more complex types of transactions. So hopefully now you know assets, liabilities, and equity. You know what creditors and investors are, and you understand the accounting equation. So next class, like I said, we're going to use the accounting equation more, look at more different types of transactions, learn about more specific asset, liability, and equity accounts. So we're just going to be building on what we've already learned. But thank you for spending this time with me to get a good head start on our next lecture so that we can make the best use of our time. If you have any questions about this lecture, please feel free to ask. You can either send me an email. You can write it down and ask me in class if you'd like. You can also use the raise your hand discussion board, which is in our Canvas site if you'd like to ask questions to get those clarified before the next class. Thanks again, and I will see you in class.